Last week I told you to watch the $3,100 level on gold, specifically whether spot held that level on a weekly close heading into the end of quarter. I said if it closes above $3,100, the institutional bid is still intact and the move higher has more room. I want to take a moment on why that level mattered before. We move forward because understanding the logic behind a call is more valuable than the call itself. $3,100 was not an arbitrary number. It was the level where the most recent wave of institutional accumulation clustered over a 3-week period. When price consolidates at a level that long, it tells you buyers there are committed. A weekly close above it meant those buyers were still in control. A weekly close below it would have meant they had been overwhelmed. That distinction, committed buyers versus overwhelmed buyers, is the difference between a trend continuing and reversing. Here is what happened. Gold not only held $3,100, it closed the week above $3,200, pushed through $3,300 in the days that followed, and as of now we are sitting at $3,507. That call is on record. It hit, and now the setup has changed entirely because the question is no longer whether gold can hold $3,100. The question is whether gold can handle what is coming this weekend. That is exactly what this video is about. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have seen what happens when retail investors get the wrong information at the wrong time and what happens when they get the right information but fail to act because it was not explained clearly. That is why I am here. This is Currency Insider, and if this kind of calm, data-first breakdown is what you have been looking for, hit the like button. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger story building week by week. Everything I show you comes from publicly available sources. Here is what we are covering. First, what the Monday gap risk actually is and why it is at its highest level in months. Second, the two scenarios that could play out this weekend, one that sends gold sharply higher and one that sends it sharply lower. Third, the industrial demand layer almost nobody is discussing. And fourth, the three lanes framework, how I am thinking about positioning heading into Sunday night. Quick question before we go further. Are you currently holding physical gold, mining stocks, or both? Drop it below. I read every comment and it helps shape what I cover next. Let me start with where gold actually is and why this weekend is different. Gold closed at $3,507 per ounce on Friday. What stood out was not the price itself, it was the weekly range from near $3,460 to touching $3,550 intraday. That is a $90 move in 1 week. A year ago that would have been remarkable. Now it is normal. That shift tells you volatility expectations have increased and markets do not do that randomly. What is driving that volatility? Three things. A 10-day halt on strikes in the Middle East entering its final hours, a US-Iran negotiation that has stalled twice this week, and an April 6th deadline after which the current pause reportedly expires. Think about that. A temporary ceasefire with a fixed expiry, negotiations failing twice in the same week, and a market already up $400 trying to price what comes next. This is not slow uncertainty. This is uncertainty with a deadline, and that deadline is this weekend. Gold did not rise to $3,507 because everything is fine. It rose because the market is pricing uncertainty. The question Monday morning will answer is whether that uncertainty was justified or not. Here is the Monday gap concept explained simply. Markets close Friday and reopen Sunday night when the Asian session begins. That gap is a blind spot. No hedging, no price discovery, no adjustments. Whatever happens geopolitically gets priced instantly when liquidity returns. Think of it like pressure building behind a valve. During the week, it releases gradually. Over the weekend, the valve closes, pressure builds. Then Sunday night it opens and everything comes through at once. The reason this weekend's gap risk is elevated is not just the ceasefire deadline, it is the combination of the deadline, stalled negotiations, and existing positioning. When all three align, a significant gap becomes likely. The CFTC's Commitment of Traders report shows managed money is long, but not at extremes. That matters. At extremes, gaps trigger cascades, margin calls, stop losses, forced selling. Right now we are below that threshold, which means a move can sustain instead of reversing immediately. Now let's walk both scenarios. First, the cautious case. The 10-year Treasury yield is sitting at 4.42%. That matters more than most people think. You are choosing between two options. Option A, gold, which yields nothing but benefits from instability. Option B, treasuries, paying 4.42% annually with government backing. When yields are this high, institutional investors constantly compare the two. If geopolitical tension eases even slightly, that 4.42% becomes very attractive. The premium currently built into gold, the geopolitical risk premium, compresses. If that happens, gold can move quickly back toward $3,300. That is the bear scenario. It is real and data supported. This is not a call to sell, it is a call to understand the risk. Now the other side, the bull case rests heavily on central bank buying. Central bank accumulation has remained consistent this year, and this type of demand is fundamentally different. Hedge funds trade, retail reacts emotionally. Central banks make long-term strategic decisions. They are not reacting to weekend headlines. They are answering a structural question: reduce dependence on the dollar or not. That does not change because a ceasefire holds. If tensions escalate, negotiations fail, strikes resume, you could see a strong gap higher Sunday night. Gold could push toward $3,600 quickly. Physical premiums would spike and late buyers would be left behind. Both scenarios are real. Your job is not to pick one emotionally, it is to observe which one unfolds. Now the industrial layer. Gold is not just a fear asset. It is also used in electronics, medical devices, and aerospace. This demand is structural. It does not disappear with news flow. If gold dips toward $3,300 due to easing tensions, that dip is not landing on empty ground. It is landing on real demand. Central banks and industry. Think of gold like a balloon. The geopolitical premium is the air, it can deflate quickly. But the structure, physical demand remains. Confusing a temporary dip with a structural collapse is one of the most expensive mistakes investors make. Now the 3 lanes framework. Lane 1, paper market. Positioning is long but not extreme. That is cautiously constructive. Lane 2, physical market. Dealer premiums remain elevated. That signals steady demand. This is supportive. Lane 3, macro. Long-term fiscal expansion and de-dollarization trends remain intact. That is constructive over time, though higher yields create competition. Right now, lanes 2 and 3 align. Lane 1 is neutral positive, not perfect alignment but important. Here is what I am watching. Sunday night's open. If gold opens more than $40 above $3,507, escalation is likely. Then watch if the gap holds. If it holds for 2 hours, it signals real buying. If it fades quickly, it is likely profit taking. If gold opens flat or lower, focus shifts to $3,460. A break below opens a path to $3,300, above $3,550. Opens the path to $3,600. Those are the key levels. Before we close, disclaimer. This is educational content based on public information. It is not financial advice. Always consult a professional before making investment decisions. If you got value from this, hit the like button. It helps more than you think. 2 questions before you go. Are you changing your position this weekend or holding? And which lane do you think moves first Monday, paper, physical, or macro? Drop both below. I read every comment. Subscribe because next week I will break down exactly how to read Sunday night price action in real time. This is Currency Insider. Know the market, protect your currency.